Happy Wednesday, Asher here. Welcome to this week's market update. We've got a lot to cover today. Inflation trends, rate resistance, buyer demand, and some info from the Fed. Let's dive in. First up, 10-year Treasury yields are testing a major level. We've seen a steady rise since the start of the month, from around 4.13, now flirting with 4.5%, which has been a strong ceiling of resistance. We've seen this level hold before in early April. It stopped a rally cold, and we're testing it again. If we break through, we could head towards 4.59%, but if it holds, we've got room to improve back towards the 100-day moving average around 4.41%. So far, it's holding. Mortgage-backed securities are slightly negative today, down about 12 basis points when I'm recording this video, sitting just above an important floor of support. The charts are tight, technicals are key here, and all eyes are on inflation data. CPI was tame again in April, continuing the trend we saw in March, and tomorrow we'll get the PPI, the Producer Price Index. Expectations are soft, about 0.2% monthly on the headline with 0.3% on the core. If those hit, the year-over-year readings could fall, which could help the bond market and potentially improve rates. And let's not forget, retail sales tomorrow morning. The core number gets plugged into the GDP. If it comes in soft as well, it could benefit bonds. But if it beats expectations, stocks will like it at the expense of mortgage rates. Rent inflation continues to fall, even if CPI doesn't fully reflect it. Realtor.com's April data showed that new rent is down 1.7% year over year, and the 21st consecutive month of decline. Vacancy rates are also climbing, now at 8.2%, which pressures landlords to drop prices. The CPI shelter component remains overstated. Real-time numbers suggest inflation may actually be 0.5% lower than reported. Mortgage demand continues to show strength even as rates ticked up slightly this week to 6.86%. Purchase applications rose 2% last week and are up 18% year over year. Refi apps were nearly flat week over week, but they're still up 44% year over year. The refinance share of activity is slipping slightly, but still remains solid. The buyer activity index dropped sharply, with weakness seen across all regions, likely driven by economic concerns and Q1's negative GDP print. But here's the opportunity. Home price direction is cooling, and seasonal timing is ideal. That gives buyers a strong entry point, especially with tools that I have available to them and to you, like the appreciation calculator, the cost of waiting analysis, etc. Meanwhile, the Fed held rates steady at 4.25% to 4.5%, waiting to see how trade policy plays out and how it impacts the economy. Powell is cautious. The Fed doesn't want to cut prematurely, especially with inflation still above target. But internal cracks are forming. GDP was negative last quarter. Recession risk is climbing, now at 57% per the bond market. And job growth, while strong on paper, is softening underneath, especially in economically sensitive sectors like transportation and warehousing. We're also seeing a shift in mortgage policy. The CFPB rescinded 67 prior guidances, including those related to fair lending and earned wage access. This is part of the broader deregulation trend under the Trump administration. We're also watching a new bipartisan bill to raise FHA multifamily loan limits for the first time in 22 years. That could boost affordable housing development if it's passed. And here's a stat to finish with. The average homeowner now stays in their home for 11.8 years on average. That's nearly double the average in 2005. In places like LA and San Jose, median tenure is over 17 years, probably driven in part by tax incentives like Prop 13. In contrast, fast-growing markets like Nashville and Vegas are still seeing much shorter tenures, around 8 years. Bottom line, mortgage demand is strong, especially on purchases. CPI and rent data suggest inflation is overstated. Charts are tight. The 10-year yields must stay under 4.5%. Buyers may be cautious, but this market has real opportunities. And remember to keep your tools ready and for you to be the expert that your clients are counting on. Well, that's all I have for you this week. Let me know if you need any help running numbers, strategizing with buyers, or if you just want to stay ahead of some rate movement. Thank you. I'll see you next week.